Good afternoon. I'm Francine Lipman. I'm a William S. Boyd Professor of Law at UNLV's William S. Boyd School of Law, and I am thrilled that you're joining us today. It's only noon on the West Coast, so for those of you that are out here, good afternoon. We are thrilled to be presenting on behalf of the ABA Civil Rights and Social Justice Committee section. It's the section, but this is the Economic Justice Committee. COVID-19 and tax relief for individuals and tax exempt under the CARES Act. And CARES is an acronym, and I'll spell it out for you just because I think it's kind of curious to see what it stands for. Coronavirus Aid, Relief, and Economic Security Act. As I said, this is sponsored by the ABA, Civil Rights and Social Justice. This panel is one of a series, and I encourage you to go to the ABA Civil Rights and Social Justice website to see, literally, they are covering every possible corner of these issues, focusing on civil rights of many people of color and other vulnerable populations. So go to their website and tune in to any of the webinars. Literally, there's one every single day, sometimes twice a day, and they're all free. So thank you, ABA, for that. We're actively planning additional programming, so always check in. One of the things we can all say about COVID-19 and certainly the tax provisions and all of the other economic provisions, they are dynamic. We encourage you to ask questions of our panelists. As an attendee, you should see a control panel that will control your audio options, chat, raise hand, and Q&A. For the purpose of this webinar, we ask that you submit your questions through the Q&A, not the chat. And we're able to see those questions. We're going to try to incorporate the questions into our conversation. However, some of them we might not get to until the end if it doesn't squarely fit in with what we're talking about. But we want this to be interactive. And I was telling my co-panelists, I did a similar type of webinar yesterday, and it was really fun because all 300 participants were engaged and asking questions. And as a tax law professor, oh my gosh, I was like on fire. I loved it. So I hope you'll join us for some Socratic method. We won't ask you questions though, so you get to ask us questions. If you don't see these controls, please ensure that your screen has not fallen asleep. So touch the mouse, jiggle it, don't knock it on the floor or anything, but we'll answer your questions, as I said, kind of dynamically. We will be sharing a recording of this program to everyone who registered. So you will get a recording, and it will also be on the website. That might not happen until Monday because our website is so active, they have to maintain it this weekend. If we don't get to a question, we will do our best to follow up after this program. And with that, I'm thrilled to bring to you my co-panelists. So I cannot tell you how lucky you are to have these two gentlemen together on one webinar. They literally are, and I've been doing tax for longer than I'm going to tell you, but they literally are my go-to tax-exempt scholars, academics, experienced professionals in government as well as in the private sector. And they are not only brilliant, bold, engaged, and dynamic and creative, they are generous and very philanthropic. So I can tell you without hesitation, when I've reached out to either Brian Yacker or Philip Hackney for a nonprofit that is struggling and needs some assistance, without question, they rise to the challenge. And in these difficult times, those are the type of people on the front lines of tax justice we want to engage with. And so let me introduce them. To, I think, my left, maybe you're right, I don't know where on this screen, in cyberspace with me is Brian Yacker, and he is the managing partner of YH Advisors. He has a practice, a for-profit practice in Long Beach, and he is the go-to guy in my time zone, definitely. What's wonderful about Brian is he not only services close to 1,000 clients and rising, but as I said, he's very engaged with the ABA tax section and doing pro bono work on the front lines. In addition, he is really active in doing his own outreach and education on a regular basis. So go to his website. It's YH Advisors, and I'm sure if you Google that, it will come up. And you can put in your email, and so you can be on his listserv, because he's constantly doing, you know, newsletters, webinars, etc., and they're all pro bono, and you want to become his friend. I'm telling you, he's the go-to guy. Right below me, at least on my screen, is my wonderful tax prof colleague, Philip Hackney. He is, despite the fact he looks like he's flying this airplane, he is a phenomenal scholar, academic, author. He also has been on Rachel Maddow's show, which I am so jealous of. He is on Twitter. He's got an active account, so follow him on Twitter. But most importantly, he is at the University of Pittsburgh School of Law, teaching future lawyers to be the best that they can be. He teaches partnerships, which of course is like the hardest class in law school. So definitely he has risen to the challenge. In his practice, so he has a great amount of experience. He not only clerked for the Fifth Circuit, he also worked for IRS in their tax-exempt area for, I think, 5 years. And then he also practiced law and has taught in a couple academic institutions, including LSU. He's kind of a Louisiana boy. He also, most interesting, had a rare bookstore and coffee shop. And so maybe he'll do that again in Pittsburgh. I'd love to see that. And his wife is a phenomenal artist. But, you know, I could go on, and I usually do. But we have a lot of substantive tax material that we want to share with you. And I get to, so just to give you a little bit of where we're going, I'm going to spend about 20 minutes talking about some individual tax provisions, just to kind of get us started and thinking about the CARES Act. And then after I've gone for about 20 minutes, I'm going to turn it over to my colleague, Professor Hackney. And then following up at the end will be Brian Yacker. And without further hesitation, I'm going to get into my PowerPoint, and please don't hesitate to ask questions if you have them. So here we go. So here is my contact information, and please do not hesitate to send me an email. I am ready, willing, and able to try to help you navigate these issues, and I am very responsive on email. I also have a pretty active Twitter account. I've got it up there, and for those of you that have kind of eyes that maybe read things backwards, that actually is my name backwards. It's a long story how that became my Twitter handle, but in any case, please follow me on Twitter. And if you have any follow-up questions, don't hesitate to send me an email. I am doing my best to answer all the emails as quickly as I can, so give me a little bit of patience. We're still teaching at UNLV, and yes, Maria, you will get a copy of the PowerPoints. Absolutely, we will provide those. Each of us has one, so happy to share those. So as you know, Congress passed the CARES Act on, it seems like a long time ago, but it was only March 27th. And literally, since that was signed into law, it has been all hands on deck in government, in the private sector, and we have been trying to figure out all of these very broad-based provisions. By the way, the statute is about 900 pages. And not surprisingly, we're not getting good feedback from the government because they're just trying to implement this. And so it's very frustrating yes, we're gonna talk about nonprofits. And so Riley, thanks for tuning in. After I'm done with my individual portion, Professor Hackney and Brian Yacker are going to focus on tax exempts. And so you can ask questions then. So as I said, this is incredibly dynamic, 900 pages. Everything is really happening in real time, literally. And so what we are trying to do is just figure out what's going on. And the government hasn't been perhaps as responsive as they would be in normal times. We all know this is not normal times. They are just trying to push the money out. So they're trying to, they have been very nimble and very responsive, but some of the more arcane questions we haven't gotten answered to, but we're able to reverse engineer them to a certain extent. So the most important thing for you to do to be up to date is to check out irs.gov. Just yesterday, they added a bunch of answers to frequently asked questions. In addition, many of you I know you're across the country, and so your state taxing authority is also going to have a website and COVID-19 updates. In addition, tax notes, I happen to be a writer for tax notes, a pro bono writer, tax justice writer for tax notes. They have, outside of the paywall, COVID-19 tax issues. So there's a plethora of information out there, and I know it can be overwhelming. So if you want to look at one resource, irs.gov, great information on the front of their website. Everything is changing, so be careful and cautious to have up-to-date information. I will tell you, there are things that I said that are no longer correct because we got subsequent updates. And so be patient with people. We're all trying to do our best, but I was on a tax talk a town hall, say that quickly, and our congresswoman was saying that we're really trying to build this airplane as we're flying it. And so check daily, things are changing, and the government is trying to be responsive. As I said, government is trying to be responsive, and I can tell you, grassroots efforts have resulted in meaningful changes. So if you see something that is systemic, that isn't working for a population, especially a vulnerable population, reach out to your member of Congress. By the way, they're scrambling too, so do it in a constructive manner. And I'm telling you, as somebody who's on the front line advocate for low-income taxpayers, I have seen changes. Not only low-income taxpayers, but all taxpayers. And I'm going to give you some example of that. The IRS commissioner, who happens to be someone who I know and respect very much, Chuck Reddick, he reached out to all of his liaisons and partners in the low-income and other communities, especially English as a second language, homeless shelters, women's shelters, food banks. they want to work with taxpayers to get this money. Social Security Administration, Veterans Affairs. So it's all hands on deck. We're stronger together. And I think that there is no other time I have sensed that than now. I really feel committed to you, each of my taxpayers across this country from sea to shining sea. We all want to help you. So let's dive into what the government has been doing to make this a better situation. So as I said, the first thing that really came down the pipe was, as you've all enjoyed and experienced, for the first time since like forever, the due date for individual income tax returns was automatically, it initially was just postponed until July 15th. Well, many of us became frustrated with that because we said, why are you having people have to file an extension form, especially when volunteer income tax assistance programs are shuttered, when we don't want people to leave their home, especially the most vulnerable senior citizens, etc. So the government responded. That's a great example of grassroots efforts that worked. So now you didn't have to do anything to postpone the filing, and not only the filing of your tax return, but the due date for your tax payment. As you know, or now you're gonna know, it's pretty easy to extend the filing of your individual income tax return. In fact, you can get an automatic extension for 6 months up to October 15th, but you could not extend the time to pay. So this is an extension of the time to pay. And it's not just your individual income tax return, it's a myriad of other tax returns, corporate tax returns, refund claims from 2016, the statute of limitations would have run on April 15th, and some other nonprofit returns that my co-panelists are going to talk about. So it's broad-based, and the IRS website has all of the details here. But and including for individuals, your first quarter estimate for 2020 was typically due on April 15th. That was your first quarter estimate for your federal income taxes for 2020. That is postponed until July 15th. They also recently postponed the second quarter. Second quarter is typically due June 15th. And they had not originally postponed that, and now they decided to postpone that, so that's good news. The good news is all of this is postponed until July 15th. The bad news, though, for a lot of folks is that is a significant amount that is going to be paid for taxpayers. So and interest and penalties have been abated for this period as well. And so what's interesting is starting July 16th, interest and penalties will start to accrue again. And so someone asked Angela if that extends the CSED date. I does not believe it does extend the CSED date. So I know the IRS is concerned about statute of limitations, so they are watching those on their ends as well. You might want to look specifically at the IRS website because that could be dynamic. I'm going to talk about the People First initiative that they have. So taxpayers have to have on their radar July 15th because, and of course that's dynamic, that could change. What is interesting, and taxpayers might think about doing this, you can now electronically extend your individual income tax return by going online using free file fillable forms. Say that quickly 5 times. So free file fillable forms, you can find that link on the IRS website, and you can file an extension to extend your individual income tax return to file it by October 15th. You might want to do that, but again, that doesn't extend the time to pay. The other thing that I'm telling all Nevadans in and people across the country, file your return just because the deadline has been extended. If you're getting a refund, please, please file it. We need you to get that money so that you spend it, so we can get the multiplier effect in our local communities. So we shouldn't discourage anyone from filing. The problem, though, is volunteer income tax assistance programs. Many of them are shuttered. I know a lot of them are doing virtual VITA. So I know in Nevada, we're going to start that soon. So it's virtual VITA. So go to the IRS website and you can find the VITA, volunteer income tax assistance sites in your area, and see if they're going to do things virtually or with drop-offs. So maybe you can get it done that way. You can use free file on the IRS website, certainly to file it electronically. You can mail in a paper return. So they are accepting mail, obviously. Anything that is postmarked, the timely mailing is timely filing is, of course, going to be respected. The problem is they're not processing paper. And I read recently the US Postal Service says they can't hold any more mail for the IRS. So the IRS is having to lease warehouses just to hold all this mail. So you can only imagine how much mail they're going to have when they get back to work. So be patient. It's going to be a slow process. And I'm even seeing, so if you electronically file your return, you can check on the refund. I'm seeing those returns that are maybe a little bit less traditional being slow to process because they require interaction. Yes, so I'm going to talk about the stimulus check and stimulus payments in just a minute. So in any case, get your refunds for 2019. And if you haven't filed for 2018, please do that as well. This is a good time if you're sheltering at home to go online and file electronically. In addition, if you want to see your tax transcripts, you can go online and get those. You can check on your refund, and there's great portals for the economic stimulus payment. So what else is happening? Well, there's a People First initiative. The People First initiative is the IRS initiative outside of the CARES Act, and basically what they're doing is they're kind of shutting down collection activities until July 15th. So if you could not pay a tax liability and you entered into an installment agreement with the IRS prior to this COVID-19, those payments are suspended until July 15th. However, you have to proactively affect that. So that doesn't happen automatically. So you're going to have to contact your bank to have them stop that. So while you're not going to be penalized in any way if you don't make those payments, you have to affirmatively suspend that. So please do that proactively, and you won't be penalized, but you have to contact your bank not to make those payments. Offers and compromises, no new offers and compromises during this period. And if you had offer and compromises when you try to mitigate your tax liability based upon your financial status and hardship. So if you had materials due during that period of time, deadlines are suspended until July 15th. The government is also effectively sheltering in place. So their people are all hands on deck and doing other things. Liens and levies are suspended. They're not going to automatically impose these during this period of time. If you have a significant understatement, the government can actually take your passport, suspend your passport. They're not doing that. They're not sending debt to private debt collectors. And most interestingly, the tax court calendar has been shut down until the end of June. Of course, that's dynamic, so that might change. But what that means is it also is suspending the 90 days that you have to petition for the tax court. So I would encourage you, if you have any questions about the tax court calendar, so everything is kind of shut down to a certain extent. They are in limbo, and it's pretty difficult to get information to the IRS. I know periodically their fax machines work, they don't work. I've heard that sometimes they're processing powers of attorney or withdrawals, and sometimes they're not. So it's been a dynamic situation. I would encourage you to contact maybe your local taxpayer advocate and see what the status is. So keep trying, and don't it's dynamic. Now I want to dive into these economic recovery payments. And so you might have heard a lot of different names for these payments. So let me try to clarify that. The IRS is calling them economic impact payments. They're intentionally not calling it a stimulus payment because they feel like some of the outside for-profit people that are trying to maybe take a piece of this action are calling it that. And so they're very worried about scammers. So everybody beware of that, and tell people you don't need to pay anyone to get this money. It's free. It's coming free. You can access it readily. So it's called economic impact payment. I've been calling it the rebate recovery. Why? That's what the law calls it. But in any case, let me explain to you how it works. So this rebate recovery is a refundable tax credit. It is a refundable tax credit for 2020. So on your 2020 tax return that you're going to be filing in 2021, so a year from now, even less than a year from now, you're going to claim this credit. But you're going to have, and it's a brand new credit on top of all the other credits, and it's up to $1,200 per person and an additional potential $500 per qualifying child. You're going to claim that credit on your 2020 tax return, but you're going to have to offset any advance amount you get. So if you're owed more when you calculate it for 2020, maybe because your income went down, you had a child, you're no longer a dependent, or you got a social security number, or you're no longer a non-resident alien, or your spouse got a social security number. For all those reasons, you will get it in 2021 when you file your 2020 tax return. However, because the government wants to push this money out as fast as possible, what they have done is they are advance paying it. So they're advance paying it. So it's not that you're not, that's coming out of next year's refund. It kind of is, but that's because you're getting more. They're adding on top. So you can't get it twice, but you are getting in advance. And the good news is, if what you get now is more than what you would have gotten in 2020 that you you don't have to pay it back. So God forbid somebody should die, you don't have to pay that back. Or if a child ages out by 2020, you don't have to pay it back. So that's good news. So this is very taxpayer favorable. So how does it work? Well, it starts off that it's $1,200 for each individual, $2,400 for married filing jointly, and an additional $500 for qualifying children. What is the qualifying child? It can be a grandchild, a niece, a nephew, a brother, a sister, an adopted child, a foster care child, who's formerly a foster care child, as long as they have a valid social security number and are under age 17, that's important, who live with you in the United States for more than 1/2 of the tax year. So if on your tax return, And by the way, because they're advance paying this out, they're going to look at the most recently filed tax return. So that could be either 2019 or 2018. They're going to look at 2019. If 2019 doesn't exist, they'll look at 2018. They will not look beyond 2018. So they're not going to look back. I am not going to be able to talk about the payroll tax credits, but we're going to do another one, and I'm going to talk about the payroll tax credits. So you get the tax credit. If you have no income, but it does phase out at higher brackets, which I'm going to talk about in a minute. And let's see what else. So paper return mailed in January or February, I don't think it will be processed, honestly. I think that that's not going to happen. Thanks, Anonymous. Glad to see you back. So they're going to look at those returns. If there's no return on file, then you might not get it until you file your 2020 tax return. If you're not, you can file a return now. They're going to keep pushing this out for the next, they're going to push it out for this entire year, but the sooner the better, and the sooner the better electronically. So maybe in January or February, I don't know. You just have to see what happens, Anonymous. And if you are not required to file a tax return because your income is so low, then you can go onto the IRS website, and they have a portal for non-filers who can enter their information, and they will get, including their direct deposit account information, and they'll get their economic impact payment electronically. So as some of you asked about income, by the way, you don't have to have any income to qualify for this. And this economic impact payment itself is not income, and it is not counted for any means tested social benefits. So that's not counted. It phases out down to zero, starting with your adjusted gross income. So we're going to look at your adjusted gross income, and if your adjusted gross income based upon your filing status is above $75,000 for single or married filing separately, 150 for married filing joint, and in between there for head of household. For every $100 above that threshold, you lose $5 of your economic impact payment. So that's going to be based upon 2019 if you filed it. So maybe maybe you had a good year, and so it's phased down to zero. Okay, maybe it's phased out to zero because of 2019. The good news, or the bad news, is if you lose your job for 2020 because of COVID-19 and you file your 2020 return in 21, you'll get it then if you're not phased out. By the way, the $500 qualifying child amount also phases out to zero. And I do have an example of my phase outs, but I'm looking at the time. I'm not going to go through those examples unless we have time at the end. So I do have some mathematical examples, which is in the PowerPoint, and so you'll see it. But this $500 does phase out. By the way, the $500, when we look at the $500, we age it. The phase out numbers again, 75,000 is the beginning of the threshold for single, married filing separately, married filing jointly is double, 150. Head of household is in the middle, okay? Everybody who gets this payment must have a social security number that's valid for work. The good news is dreamers count because they have a social security number that's valid for work. In addition, temporary workers like farm workers who are treated as resident aliens, they have a valid social security number that qualifies for this as well. One exception, and by the way, if you're married filing joint, you both have to have the social security number valid for work. So one way to get the credit is to file married filing separately if your spouse has an ITIN, doesn't have a social security number. So that might be something people should think about for 2020. However, I want to really caution you because there are a lot of downsides to married filing separately. So we should have a whole separate CLE on that. Okay. And the other thing is you cannot be claimed as a dependent on another person's tax return. So anyone who is claimed as a dependent on another tax return does not get this. So if 2019 you were claimed, you were counted as a dependent on somebody else's tax return, you're not going to get it. But if in 2020 you are no longer dependent, you'll get it. Okay? And so that's another analysis. Non-resident aliens don't qualify for this, and the good news is there's no tax refund offset. So the only offset, the PowerPoint is going to be available to you on the website and will also be emailed to you. So good question, Crystal Libera. As far as I know now, mom and dad both have social security numbers. If a child on that return has an ITIN, I do not believe now it will disqualify you. The good news is if one of the members of this couple is a member of the armed services, then only one of the spouse needs to have a social security number. So that's important. All right, let's talk about the IRS website. There's my example. Do it if we. So now, what do you need to do? Well, the good news is check your checking account. Check your checking account because the first payments were sent out last Friday, and I'm not kidding you. 80 million, $150 billion went into checking accounts this week. So yours might already be in there. The IRS has a portal now, I think it just went up yesterday, that says, get my payment. You can go on there to check the status of your payment. You should also go on there if your 2019 tax return was an amount due and they electronically pulled money out of your account or you paid by check, because they do not have direct deposit account or authorization or information for you. So you need to input it. Do that sooner rather than later. Go to that website, be patient. Something like 8 million people accessed it yesterday. So go to that website and input your direct deposit information. In addition, but you cannot change your address, or if there was a depository bank account, you can't change that because they're worried about fraud. But what will happen is the IRS is going to mail a letter to you within 15 days telling you they put the money in the account, how much and what account, and what to do if you didn't get it because maybe the account was closed. My guess is there'll be a phone number or a web portal for you to try to fix that. The alternative, if an account is closed, it'll bounce back to the government and then they'll likely send you a check. My understanding is paper checks are going out beginning of May. Okay, here's a big one. What if you are Social Security retiree, or you have SSDI, or you received SSI, Supplemental Security Income? If you receive any of those and haven't filed a return, the great news is you do not have to file a return. You do not have to enter any information. You will get it automatically deposited into your monthly account that you typically get. However, if grandma and grandpa are taking care of their grandchild that's under 17, and they haven't filed claiming that kid is a dependent, the IRS doesn't know that kid's in your household. So you need to go into the non-filer portal, which is on the IRS website, and enter the information for that dependent so grandma and grandpa can get an extra $500. Let's see. I think that I have definitely used up my time, and I already apologized to my co-panelists, but I am going to sign off, and I'll look through these questions and try to answer some of them if we have time at the end. This is a dynamic situation. As you can see, I'm animated about it. I know a lot about it, and I want to share the information. But what I'm going to do right now is turn it over to my wonderful colleague, Professor Hackney.
Hi, how's everybody doing? Thank you, Francine. That was fabulous. And yes, it is incredibly dynamic right now. Things are changing every day. So, and the information that we had today is often different from what it was yesterday. I'm going to go ahead and share my PowerPoint here. See if I can find it. There it is. Share there. And now I'll start the slideshow. Thank you to the ABA for setting up this. They're doing a fabulous job in this new world of sharing through Zoom and other means. We've all been struggling in various ways, and I think this group hopes that we can help folks a little bit in accessing dollars that might be available, being aware of them and how to deal with them. So I'm going to talk about a few parts of the Act where Congress has tried to help out. I focus primarily on the charitable giving, the retirement, and I talk a little bit about the unemployment assistance, and then I mentioned a few other programs. So let me get moving on that. The charitable giving. What did Congress do to incentivize Americans who can to provide to those in need? They came up with this thing that there are a few folks have pushed for some time, which is a universal charitable contribution deduction. It's only for 2020. There is some debate about this. The way Congress wrote the timeline of it, it begins, it applies to taxable years after the 2019 taxable year, is kind of strange. I believe it only is for 2020. That's the way the Joint Committee on Taxation scored it. It's the way the legislation reads, but the way this works is most people aren't able to take the charitable contribution deduction anymore. As a result of the 2017 Tax Act, the standard deduction was increased so much that most people aren't able to itemize anymore. It's maybe 9%, 7 to 9% of people who are actually able to itemize anymore. So when you make a contribution to a charity, you're generally not getting a charitable contribution deduction. What this act does is everyone that pays tax can take a deduction above the line, which means you're going to get it. You don't have to itemize to do this, of $300. My big ask for you, think about giving, if you have the means to do it, think about giving that $300 today. You'll get to write it off next year. It has to be in cash, cannot be to a donor advised fund or a private foundation, supporting organization, but you can make a real difference in people's needs today, particularly with food banks and such. They did a few other things, such as they eliminated, and this really is focused more on high income individuals, I think. It eliminates the 60% ceiling on cash gifts to public charities in 2020. So someone can deduct up to 100% of their salary in the year. And this opens up potential for folks who really do have the means to do that. This is the time to do it, and you have the tax ability to make that happen. Congress, by the way, is considering a larger universal charitable contribution deduction, like the $300 one. There's an effort to get $3,000, so you might keep an eye out for that. Excuse me, I moved that too quick. They have increased corporate giving. So corporations usually could only do 10%. They've increased that to 25%, so they make it more accessible to corporations to make these donations. And there are a few things that are going against it. So this is my fourth point here. When we get to the retirement provisions, we're going to find out that though individuals who are 70 and a half or now 72 and older can do rollovers into charities, They don't have to make their minimum payment this year, and I'll get to that. They did one other thing, which is they increased the limit of deduction of food from 15% net income to 25% net income. So this is a specialized situation with those who have food in their businesses. They're able to make a little bit more deduction. So hopefully with that food glut out there, there might be some opportunity to move that food to food banks. Let's see, what else I did want to say something. There's a tendency right now, just while I'm talking about the charities, many private foundations and public charities who have endowments tend not to spend in these times because they see a real downturn in their endowment. Their portfolio, just like your retirement plans, are down. I hope they start considering moving those dollars out. So I hope to see more of those nonprofits moving in that kind of way. All right, let me move on to the next one here. So the retirement provisions. The first one I have up here, and just to think about this generally, right? We're trying to think about all pots of money that are out there to help people maneuver through this unprecedented situation where we have folks losing their jobs, not having money coming to them. So what can they do? The first one actually isn't really focused on those in need exactly, but I think it is an important one. So they waived the minimum distribution requirements for IRAs in 2020. These are for folks 70 and a half and over. Or those 72 since the 2017 Tax Act. I think it's to ensure that folks who are depending on retirement don't have to sell those dollars into a bear market, a significant bear market. So for those that have the means, they can stop those payments so that they don't have to sell off some stock that's at lower dollars. For those who already took a distribution, if it's recent, there's the possibility of a 60-day rollover, so you could potentially put those dollars back. These next are possible solutions for those engaged in disaster planning. So you're sitting there, maybe I'm going to lose my job, maybe I've already lost my job. How am I going to deal with it? Maybe my spouse has lost their job and we're trying to figure out how to make ends meet. And this is really where the second part comes in, and this is my second major point here. So it eliminated the 10% penalty for some withdrawals from retirement accounts of up to $100,000 for those under 59 and a half. In order to have this one opened up, there's a few things that have to happen. You or your spouse or dependent must have been diagnosed with COVID-19, or you've somehow suffered a financial consequence related to COVID-19. Additionally, your employer must allow this. My understanding from what I've been reading so far, for instance, Fidelity has said they believe most of their employers are going to allow these types of withdrawals. It'll be retroactive to January 1st, 2020, and you'd have to take it in this year. Question becomes, should you do this? I am not a financial advisor, so not in there, but from what I have read into this space and thoughts about it is, if you're at the end of the rope, this is something you may want to consider, but you ought to be thinking about other means. If there are other ways to do it, it's well worth thinking about this. Interestingly, you're able to do things like buy boats and so on with this, but these are really the types of things you should be doing when you're really doing the disaster planning. How am I going to make ends meet? The next one is that it has doubled the amount you can borrow from a qualified employer plan to the lesser of $100,000 or 100% of the plan balance. This increases the amount that was previously there by 100%. It used to be $50,000. It's a loan between March 27th and September 23rd, 2020 for this to apply. Normally you have 5 years to repay. The Act allows you to put off payment start to 2021. So it effectively increases the 5-year period to almost 6 years. It will accrue interest during that time that you're not paying it back. What if you lose your job? There's typically a 60-day payback, but as a result of the 2017 Tax Act, they changed that to the day the tax return due for that taxable year, plus extensions, so you can actually wait until October of 2021 to pay those back without causing it to be considered a distribution. Unemployment insurance. I think this one, the focus has been on the $1,200 payments, but my guess is this is going to be of some of the most significant consequence. It was one of the most useful things that Congress did. I'm talking about it because it's really significant to the whole CARES Act plan, and it's not just a one-time thing. This goes over the time of this year, so I think it really gives some real help to those who are available for it. So the first thing is that they created a pandemic unemployment assistance. And this is available to those who are not typically eligible for unemployment insurance, such as the self-employed. So this might get some nonprofit contract work folks in there. It can also include churches. Typically, churches are not included within this. There's some lack of clarity in terms of whether a church still can qualify. Reason is because typically churches are exempt from paying into the unemployment insurance system. The Labor Department at least has suggested that you might be able to get that help. I think it's going to depend on the state as to whether it's available. That's for 39 weeks. It ends 12/31/2020. It depends on when your state implements it, when it really begins for your area. You have to be able to show the COVID-19 impact again. They have increased, and this is probably the most significant thing that happened. They increased the weekly benefit, which might have been $200-300. It really depends on your jurisdiction, the state you're in. But they've increased it by $600 a week. So this is a significant increase and does real help for those that lose their jobs. And it's from as early as March 29th through through July 31, 2020. Your state has to enter into an agreement with the Department of Labor. And so it really depends on that choice. Unemployment insurance is extended for 13 weeks, so that's another significant addition to this area. And then finally, there are federal funds for work sharing arrangements. So this is a situation where maybe you've done your company does a work reduction, so not everybody is laid off, but they've given additional money to pay into this. There's 100% covered for these types of programs. There's additional stuff in there. It's really complex, but I think the unemployment stuff will be some of the most significant areas there that we have. All right, a few other things that I wanted to hit on. Francine didn't get a chance to talk about the business provision, but for those nonprofits out there that have unrelated businesses, unrelated trades or businesses, there was a provision in the 2017 Act that stopped you from being able to use, they limited your ability to use NOLs. The Tax Act has opened up that possibility. You've seen some some articles out there talking about this provision in particular, that it gave the wealthy a lot of money. Nonprofits still should be thinking about this potential if they have an unrelated trade or business. It's a way to go back to prior years from net operating losses you have this year and collect quick refunds. There are still some challenges there. In the 2017 Act, Congress forced nonprofits to silo their trades or businesses. It's still not clear how that rule works, and we're still awaiting guidance for that. So anybody trying to use those net operating loss in their nonprofit in order to offset those things really should seek legal advice in how to think about that provision. I just want to mention a number of different provisions that are out there. Again, this act is huge, and it's got a huge source of money, particularly in the nonprofit community. It's worth your while looking into this thing a little deeper, because there are grants to community health centers, substance abuse and mental health services, child care providers, community service organizations for social service and emergency efforts. And additionally, in higher ed, there's increased ability to provide emergency grants to students with financial need under the Federal Supplemental Educational and Opportunity Program for unexpected expenses. And they can also continue to pay students under federal work-study programs if there is a qualifying emergency. Couple other things that I want to point out. IRS has a couple disaster guide provisions. One is the publication 2194, Disaster Resource Guide. I think visiting those types of things right now is really useful. Additionally, if you are a charity and you're thinking about what can I do to get dollars out the door, I highly recommend publication 3833. It does a great job of explaining how to think about those things. Francine Lipman actually has a great article on these things as well in terms of dealing with charities in a disaster. I'm going to go ahead and stop share, and I'm going to go ahead and send it over to Brian, because he's got some of the most significant stuff going on, I think, with the PPP.
All right, so much thanks for that, Phil and Francine. Wonderful. I actually was furiously taking notes here while both of you guys were presenting. So in our remaining time here, I am going to cover what is called the Paycheck Protection Program. It is just one element of the CARES Act in relation to the small business and nonprofit stimulus programs that are out there. In the time that we have remaining, again, I'll only have enough time to cover the PPP, but there are other programs out there as alternatives if a nonprofit cannot qualify for the PPP. There are other alternatives from a relief standpoint. Unfortunately, we need to begin with the giant elephant in the room. And of course, that is not a good thing. I can't imagine when it would be a good thing to have an elephant taking up the great majority of your room. Here, in this instance, the giant elephant in the room is the fact that, as reported as of yesterday or maybe the day before, the PPP program has run out of money. Initially, back when this was enacted in late March, $349 billion was allocated for these COVID-19 relief programs. And again, as of yesterday or the day before, these programs have run out of money. That said, does that make moot the remainder of my presentation here? Absolutely not. It is rather likely that additional funding will be allocated to this program. So the advice that we are giving to our clients, and we have worked with over 100 nonprofits to help them apply for the Paycheck Protection Program. The advice we're giving to those clients that have yet to file their applications, or who filed an application and it was not funded, is to remain, if you've already filed your application, keep it active. Respond to questions if there are questions from your bank. If you have yet to file your application, go ahead as soon as you can and file it, because in the likely event that there is increased funding for this from DC, then most hopefully your Paycheck Protection Program loan will be funded.
Brian,
So let's go, please.
I will interrupt you and just say we're not seeing your PowerPoint.
Oh, I didn't check share.
Okay.
There we go. You should see it now. Oh, and you missed well, you have to go back to the giant elephant in the room.
We
So
want to
there you
see
go.
the elephant. Thank you. Yes.
There's the elephant. So So let me give my summary of the Paycheck Protection Program, notwithstanding the giant elephant in the room. So the whole objective of this program, and really kudos to the folks in DC for quickly putting together a relief program, which I know has gotten a lot of negative publicity, but it was because, where this negative publicity comes from, it comes from the fact that the program has been immensely popular, and just so many small businesses and nonprofits applied for the program. So in a way, it's the fact that it's such a beneficial program led to its popularness, which has led to some of the criticism that is now being lodged against it. But anyway, the objective of the program was to quickly ensure that small businesses and certain nonprofit organizations have access to critical funds to keep their workers paid and employed during these very challenging times. Particular to nonprofits, is the Paycheck Protection Program available to all nonprofits? Unfortunately, it is not. It is only available to charitable organizations, 501c3s, and 501c19 veterans organizations. So if you are an exempt organization that is not either a charitable organization, 501c3, or a 501c19, then you are ineligible to apply for a Paycheck Protection Program loan. If that is your case, you're a non-charitable or not a veterans organization, then you should consider, even though, again, the funding for this has initially dried up, you should consider an economic injury disaster loan, and you should also consider the employee retention credits. There's also other payroll tax credits that you will be eligible for. But focusing on the Paycheck Protection Program, who are the lenders? This is an existing SBA program, although in their wisdom, Congress did open up this program to a bunch of other banks who are not typically SBA lenders. This includes many, if not most, local and regional and national banks. The Congress wanted to open up this program to as many lenders as possible to make the program as accessible as possible. Some banks have been really good about processing applications. Other banks have not been. What we have seen in our experience, and again, we've dealt with probably 70, 80 different banks in the past 3 weeks regarding the PPP, and this is, of course, just a generality. We've seen the smaller and regional, local-type banks be far more responsive and far more on top of things than we have for the larger, the national banks. If you have run into a brick wall with your existing lender, you'll see here there are a number of, we'll call them alternative lenders, or lenders you may not think about, that have gotten on the loudspeaker and yelled, hey, we are available, apply to us if you are trying to get a PPP loan and you've run into problems with your existing bank. So that listing is here on slide 8, or the slide that's on your screen here. You will have access to all this. Let's skip over the fees. That's really not relevant for what we're chatting about here. If you are applying for a PPP loan, what is your lender looking for? What are the minimum threshold requirements in order to get a PPP loan? Really, the key thing is, well, first, that if you're a nonprofit, you're either a C3 or a C19, you need to have been in operation prior to February 15th of 2020, which I would assume would be the great majority of you folks. So the PPP would just not apply to a nonprofit which became operational after February 15th of 2020. Important, Any borrower needs to make a good faith certification regarding the following. And this is all right on the PPP application that you'll file with your lender. The three certifications that must be affirmatively made are, first, that the uncertainty of the current economic conditions makes the loan request necessary to support ongoing operations. That's pretty much all of us. Maybe unless you are a food delivery business or Amazon, or maybe a manufacturer of toilet paper, I imagine that this certification would be easily done by pretty much any of us. The second certification is that the borrower, the nonprofit in this case, will use the loan proceeds to retain workers and maintain payroll or make mortgage, lease, and or utility payments. And then the final certification is that the borrower does not have an application pending for a loan duplicative of the purpose and amount on their current application. You can only apply for one PPP loan. What are the lenders not looking for? You do not have to provide any documentation whatsoever regarding a specific hardship suffered. You do not need to prove that you had sought and were unable to obtain credit elsewhere. For the PPP loan, no personal guarantees are necessary, nor is any collateral necessary in order to apply for and receive a PPP loan. What is the maximum amount that you can borrow under the PPP loan program? It is defined as 2.5 times the nonprofit's average monthly payroll costs, up to a maximum of $10 million. How are payroll costs calculated for these purposes, or average monthly payroll costs calculated? There's actually two ways to do it. The bank, whoever your lender is the final judge and jury here in terms of what they're looking for and how they're interpreting the 12 months prior. It could either be the 12 months of the calendar year 2019, or it could be the 12 months from April of 19 through March of 20. What are you looking at in that time period? Payroll costs include salaries, wages, and commissions. However, we'll get to a limitation in a second. Also includes payments made by the nonprofit for vacation, parental, family, medical, or sick leave. However, there is an exception to that related to the Families First Act. It includes for severance-type payments. It includes for nonprofits that are providing group healthcare benefits to their employees, and it also includes payments made by the nonprofit for retirement benefits. So all of those go into the nonprofit's calculation of their payroll costs. What is not included in the definition of payroll costs for purposes of calculating the amount that the nonprofit can borrow under the PPP loan program? First off, there is a cap on wages, salaries, and commissions that the nonprofit can use to calculate or to use as being part of payroll costs, and that is any compensation in excess of $100,000 does not get counted as payroll costs for purposes of the PPP loan program. So as such, let's just say a nonprofit is compensating an employee $120,000. And they compensated this employee $120,000 during 2019. If you divide that by 12 for average monthly salary, obviously that would come out to $10,000, but that would not be the case for this calculation. Only $83.33 a month, which is the 100,000 cap divided by 12 months, that gets you to the $83.33. That is the amount that would be allowed as a payroll cost, as a monthly average monthly payroll cost for any employee who is compensated more than $100,000. It is important to note that this $100,000 cap only applies to wages, salaries, commissions. It does not apply to retirement benefits or group health care benefits, meaning that if that same employee who the nonprofit compensated $120,000 in 2019 to compute their average monthly payroll costs, they can include the full amount of retirement benefits they provided to their employee. They can provide the full amount of group health care benefits that they provided to their employee, even if such employee made more than $100,000. Other types, other expenditures which are not to be included in the calculation of payroll costs are the employer's share of payroll taxes. That does not get included as a payroll cost. Any compensation of an employee whose principal place of residence is outside the United States, you cannot include those as payroll costs. Qualified sick leave wages for which a credit is allowed under Families First. That was the act that was enacted about a month ago. Those qualified sick leave wages cannot be included as wages for the calculation of payroll costs. And finally, payments made by the nonprofit to independent contractors cannot be included as payroll costs. What made this, the PPP program, the PPP loan option, so attractive, and what led to the program running out of money was the fact that there are provisions in the CARES Act to allow for the complete forgiveness or a partial forgiveness of the amounts so loaned to the nonprofit. How does the loan forgiveness work? It works like this. Once the nonprofit, and I keep saying nonprofit here, everything where I'm saying nonprofit is relevant for a for-profit, a small business who qualifies for this. But again, I'm just focusing on nonprofits here. That's why I keep using that term. The loan forgiveness is calculated based on once the nonprofit's loan has been funded, once they receive the proceeds, then for the next 8 weeks, for any amounts that the nonprofit spends on the following items in the 8 weeks following the day that their loan was funded, then they can achieve forgiveness in the amount of what I'm going to call qualifying expenditures. I know that term, qualifying expenditures, is not in the CARES Act. It's just the term we have been using within our office. What is a qualifying expenditure? First off, any payroll costs that were incurred in the 8-week period following loan funding is a qualifying expenditure. But why do we use the term qualifying expenditure within our office? Because it includes more than just payroll costs. It also includes, as a qualifying expenditure, any interest paid by the nonprofit on any mortgage obligation that had been incurred in the ordinary course of business and had been incurred before February 15th of 2020. So interest payments, mortgage interest payments, most likely can qualify or can be a qualifying expenditure. Rent paid by the nonprofit on a leasing agreement in this 8-week period that was in effect before February 15th, 2020. That can be a qualifying expenditure. Utility payments, including electricity, gas, water, transportation, telephone, and internet. Those expenditures made in the 8-week period following the day that the loan was funded, those can be qualifying expenditures. So this is all much more than just payroll costs. However, keep in mind that for forgiveness purposes, no more than 25% of the qualifying expenditures during this 8-week period can be spent on non-payroll expenses. So just watch out for that. The whole objective of this act was for nonprofits and small businesses to maintain their payroll during these very challenging economic times. But we did get this little bit of a bonus here, again, which has to do with at least or up to 1/4, up to 25% of expenditures in the 8-week period can be for those items that I briefly reviewed a couple seconds ago in order for the nonprofit to be able to qualify for full forgiveness. Is the forgiveness an all or nothing proposition? It is thankfully not. It is not all or nothing. The nonprofit will be able to achieve forgiveness on the amounts where they spent, the amounts up to the amount that they spent on payroll costs and other qualifying expenditures during the 8-week period. So just for assumption's sake, let's say in the 8-week period, following the day that the nonprofit's loan was funded, that the nonprofit was able to make expenditures up to 90% that qualified as qualifying expenditures, 90% qualifying expenditures of their loan amount in that 8-week period. Then the nonprofit would be able to forgive 90% of their loan amount, and the remaining 10% would be a loan that would carry an annual interest rate of 1% and have a term of 2 years. So at the absolute worst, if the nonprofit is not able to achieve full forgiveness and they still have an outstanding loan amount, it is an incredibly low interest loan, and they have 2 years to pay it off. And in addition, the first 6 months of interest and principal payments are waived. And so, or deferred, not waived, are deferred. It really is a program that qualifying nonprofits should seriously consider. Again, even with the elephant in the room, even with what you've heard the past day or two, oh, the program's out of money, all is lost, I'm not going to waste the time. Again, I can't, of course, cannot give a guarantee, but from what I've been reading, what I've been hearing, if I were betting, I would bet that there is additional funding that is going to be allocated for the PPP loans. And again, it's first come, first served. Get your applications in sooner than later. Very quickly, I'm not going to go over the actual calculation here. The loan forgiveness is not automatic. You need to apply to your lender and provide all the documentation that your lender is going to request. Your lender is judge and jury, and maybe executioner, in regards to the decision of how much of your loan is going to be forgiven. Very quickly, just in terms of some miscellaneous provisions here, and then I would imagine there's a number of questions that are out there on either the PPP or anything that Francine and or Phil previously presented on. I said this before, but just to repeat it again, the PPP is being administered on a first-come, first-served basis. The application deadline, as of now, I don't know if this will get pushed back, but as of right now, the application deadline for the PPP is June 30th, 2020. And this is more encompassing than just the PPP, but e-signatures and e-consents on the applicable loan documents, loan application documents, are permitted. There is just having to do with the forgiveness side, is Your forgiveness can also be limited if during the triple P period, the applicable triple P period, you suffered a reduction in your head count and or the nonprofit cut salaries of their existing workers by more than 25%. There is a formula that goes into it. I do not have the time to get into that formula. If you have questions about that formula, you can certainly contact me offline, and I'm more than I've walked through this formula for a good number of clients already. More than happy to do that offline, but I just wanted to bring that to your attention. The forgiven loan amounts will not be subject to taxation as taxable income. We've gotten a lot of questions from our clients. Hey, if I have this forgiveness, is that cancellation of indebtedness income that I have to report as unrelated business income? The answer to that is no, you do not. No taxable income related to the forgiveness. Didn't have time to go over the employee retention credit here, but if you are a nonprofit that has been considering the employee retention credits, just be aware that a nonprofit that does receive a triple P will not be able to take advantage of the employee retention credits. However, there is a bit of a exception here that you need to be aware of, that that rule that you cannot utilize both the triple P and take advantage of the employee retention credit only springs into effect on the day that your triple P is funded. So if you are sitting here today and your triple P loan has not been funded yet, definitely go ahead and take advantage of the employee retention credit. It's not anywhere near as great as the triple P, but it is definitely something. And with that, I am going to stop sharing my screen here, and I think I'll turn it over to Francine to moderate whatever questions that we have out there.
Thank you. As all of our attendees have now discovered, the way I describe the CARES Act is like drinking from a fire hose. And so take a breath, put your oxygen mask on first, and I'm watching the Q&A. There's a lot of questions about the PPP, the triple P. So I'm going to ask them on behalf of, we've just got about 4 minutes, so I'll ask some of them and everybody can jump out. Actually, I'm going to start with a question for Phil. Okay. Phil, inherited IRAs, is the required minimum distribution also abated for inherited IRAs?
Yes, it was waived for inherited IRAs as well.
I thought that was the case as well. And now about triple P. Someone asked, and I don't even know the answer to this question, so I want to hear it from Brian. What does EIPL stand for?
EIDL.
Oh, DL.
Economic,
okay.
Yeah, Economic Injury Disaster Loan.
So give a little bit of a background about that.
Of course.
As an alternative to the PPP.
Most certainly. So the economic injury disaster loans different than the triple P. It's a separate program, but it did spring to life as part of the CARES Act. So it's in the same act that gave birth to the triple P. Whereas the maximum amount that can be loaned under the triple P is $10 million. The maximum amount that can be loaned under the EIDL is $2 million. Whereas there's the potential for full forgiveness under the triple P. Under the EIDL, there is only a forgiveness provision up to $10,000, and it was called an emergency advance. or an emergency grant was the parlance we've been using in our offices. So the EIDL functions more as an actual loan, as a traditional loan, whereas the PPP functions more as a grant, especially when you consider the forgiveness provisions. The EIDL carries an interest rate of 2.75% for exempt organizations, for nonprofits, and it has a 30-year term. Final big difference is that whereas the PPP loan can be applied for basically any bank that's out there that wanted to participate in the program, you must apply for the EIDL through the SBA's website. It's only SBA lenders that can participate in that. And then finally, can a nonprofit receive both a PPP and an EIDL loan? The answer to that is yes, with a couple of very important caveats that I don't have the time to get into now. If this is something that you are interested in, definitely contact me offline, and I'm more than happy to walk through how you can apply for and receive both a PPP and EIDL.
What is the best way for participants to contact you offline?
My email address, which I guess is it's in my materials that you have access to. It's just Yacker, Y-A-C-K-E-R, Yacker @yhadvisors.com.
And I do encourage you to check out his website, which is YH as in Harry Advisors. Another question.
Exactly.
This is a great question. Can PPP loans already funded be held to terms or guidance issued after that date?
Be held, I'm sorry?
So let's suppose the government changes their terms or guidance after, because this is so dynamic.
Yes, the terms that govern your loan would be the terms that were in effect at the time that your loan was approved and funded. Yeah, things have been changed, and we've seen changes with the application. Taking Francine's words here, just everything is just changing so dynamically. Each day seems to bring new guidance, new rules, new hurdles.
Yeah, exactly. What about for businesses that were formed late in 2019? What if there's only one? What if the only employee was yourself and you hadn't drawn a paycheck yet?
That's something there's certainly provisions in there that address what you would provide. Are you eligible? You certainly are eligible for that. And you would work with your lender to provide the information that the lender needs in order to calculate your maximum loan amount. But yeah, the Act does contemplate that, and the fact that you would just give what you have. I would imagine you would provide information from whenever you came into existence through, I don't know, March 31st or February 29th, whatever the case may be.
Okay. Any last thoughts, either of you?
Oh, just everybody hang in there.
Yeah.
It's going to be a tough thing. There are resources out there, and take it easy on yourself. Breathe.
I can't say it any better than that.
Well, the captain of the airplane there, Professor Hackney, has told us to fasten our seatbelts, put our oxygen masks on first, and most importantly, shelter in place, wash your hands, and do not go out if you don't have to. I want to thank our co-panelists and give them a shout out on your Q&A. These two gentlemen are phenomenal. You ask a question and the wealth of the pearls of wisdom come out. They're always ready, willing, and able to give help. And, you know, this is all hands on deck. These two brilliant minds are helping you to be the best that you can be.
And a shout out to Francine too.
Yeah.
Amazing.
Thank you.
It's hard to find someone better than the tax maven there.
I agree completely.
Let's give a shout out to ABA Civil Rights and Social Justice. I am so happy I'm a part of this team. We want to make sure everybody considers during these challenging times making a donation to americanbar.org/donate CRSJ. Become a member, join the section. For those of you like myself who are tax nerds, civil rights and social justice and civil liberties are human rights. And guess what? Tax rights are human rights. So being part of the tax section is being part of frontline tax justice passion warriors. Thank you to Professor Hackney and Brian Yacker of YH Advisors. Both are phenomenal tax lawyers, as well as Brian and I are both CPAs as well, proud accountants. Shout out to all accountants there. For more than 5 decades, the section, ABA Civil Rights and Social Justice, and its members have worked on hundreds of issues addressing a broad range of civil rights, civil liberties, and international human rights. Please join us. This is all hands on deck, and we need you to be a part of the team, and I would be honored and humbled to be on your team. So thank you for your time. Have a safe weekend. We're going to sign off. I am going to ask my co-panelists for any of the questions we didn't get to, and we got to over about 50 questions. There are a few more open. We'll ask them to type on and answer your questions. But if not, send them an email and be safe out there. We appreciate your time and energy. Thank you.
Thank you.